With that, we'll start with our session. So I'll ask the question to my panelists. Why should banks care about stablecoins? I know BAFT published a stablecoin paper recently and was downloaded hundreds of times, so there is interest. But for that, maybe for the two of you.
I can kick it off, but it's great to be with you all. I'm Zach Wasserman. I'm Chief Financial Officer of Huntington Bank, so it's a pleasure to be with you. I'll just, at the outset here, I will say that the way we see the stablecoin and digital asset space, it's very nascent. There is not much actual activity happening right now. In fact, if you go look at stablecoins in the economy, some 95% of all stablecoins outstanding are either, we believe, held by non-US persons who want to hold US dollars, or they're being used to buy cryptocurrency. So neither of those are sort of core banking services at this point. But I would say, as I think about the banking industry broadly, there's a number of vectors of change that are driving strategic reorientation of the industry over the coming years. You think about them, artificial intelligence, it's going to drive a ton of change in customer experience, in operational processes. Quantum computing is on the cusp of being ready, and it'll really dramatically change things. The resurgence of consumer and business-facing fintechs is another one. But stable coins and digital assets, I believe, are in fact one of those really important vectors of change that will cause things to move within the industry. And you say, well, if it's not happening now, why would banks care? What's the business case or logic for why it would happen in the future? It really comes down to those things that Daniel was just polling you all. To me, I look at three big drivers of value from a digital asset. Real time in nature. It's less expensive. It's a newer tech, so it's going to be less expensive. But mainly, it's programmable. I think if you talk with a lot of folks who are actually trying to innovate use cases, and by the way, you see up here a couple of people who are trying to innovate use cases around this, something the programmability is one of the coolest parts of it. And the way that you can kind of embed the smart contract nature of digital assets into value propositions for your customers could really add new value in new ways. The two other thing I would say, before I pass it over to Titus, would just be, why should a bank care or watch this? This is the classic space, I believe, where probably most banks will be fast followers. I.e., you're not going to probably be on the cutting edge of developing services, but you'll watch what customers want to do. Make sure you're ready to provide the same kind of services to your customers. But in this case, fast will move very, very quickly. And so I think you're going to want to be very, very attuned to how the market is shaping up and how use cases are developing, because I do think the potentiality to be disintermediated is high here. And then the second thing is, it's both a threat, like I just framed it, but also an opportunity. And I think there'll be lots of ways for folks to kind of differentiate at the margin in what is, as we all know, a very commoditized industry. And so it's a pretty nice area to ideate around.
So hi from me as well. My name is Takis Georgakopoulos, so now you know how to pronounce my last name. I would say, just to add to what Zach just said, why should you care? First, because there is this thing called the Genius Act. And contrary to the stuff that you were hearing about tariffs, which today is this and tomorrow is that, Genius Act passed with bipartisan support. And therefore, you never know, but chances are this is here to stay. That's reason number one. And it lays the groundwork for how stable coins will operate in the country. The second reason you should care is because the only people that are active in the space right now are fintechs. And therefore, we or you as banks run the risk of another situation like the 2000s, where the likes of PayPal and Square created brand new ways, or Cash App, created brand new ways for consumers to interact with each other. And these companies like Stripe, like Circle, like Robinhood, etc., they come from different places. They all have great tech. They have no, legacy mainframes and stuff like that. And they have very high valuations, and they have a lot of money and a lot of smart people that are thinking about ways to create value and disrupt and disintermediate and bring efficiencies by leveraging digital currency. So that would be the second reason. And the third, which I very much agree with Zach, is because there are inefficiencies in the banking system, and you can think about money at rest and money in motion. And in both of those, the current payment system has a bunch of stuff that it does really, really well, and a bunch of stuff where, especially for consumers and small businesses, the experience is inefficient, and therefore people will try to bring kind of newer value propositions and more efficient ways to do things than we've seen in the past. And then there is a last way, which is in its current form, stable coins are not bank friendly. Like, to state the obvious, just saying it's fine, I'm just going to offer a stable coin, that's not good enough. Because as you guys know, a dollar that moves for your own bank from a DDA to a stable coin means $1 of liquidity lost, which means many dollars of ability to lend to your customers lost. So whether you look at that at the individual bank level or you look at that in the banking system level, there are things to worry about. But to the point of the optimists in the room, also a lot of interesting ideas, programmability, 24/7, new products, cross-border payments, lots of other things that you can think about. But you can't ignore it, because then collectively, banks cannot ignore it because it may go their own way.
Since you touched on the Genius Act, I mean, how important is it? I mean, or was it? And it didn't get everything right.
To get everything right, I think only time will tell, right? And typically, this kind of legislation never gets everything right. But I think just to remember where we were a year ago, where for regulators, blockchain, NFTs, stable coins, let alone crypto, were like really, really bad words. And banks were not allowed, or most banks at least, would not touch any of those things. I personally came from JP Morgan. I launched the JPM coin a few years ago, and it was extremely, extremely difficult conversations with regulators, even on kind of wholesale use cases, let alone retail. And fast forward a year later, and everyone talks about it, and I agree with Zach, 90%, there is no real use case today, and still you have $200 billion or $250 in stable coins, most of which on-ramp and off-ramp to crypto. So I would say having a set of regulatory rules that every issuer of stablecoin needs to abide by is a really good first step. Having the confidence that there is a one-to-one correspondence between a stablecoin and a deposit somewhere in a liquid asset, that's also a good thing. But then there are a bunch of things that are vague. There are questions about, if a payment account, what that's going to look like, who's going to have access to that. They say you can't pay interest, but can you give rewards, and what does that mean, and who can do what? There is no clear definition around deposit tokens versus stable coins, and I think for a lot of banks, deposit tokens may be more interesting or bank-friendly instruments than stable coins. Not much being said about that, and then not much being said about the kind of regulatory oversight of this whole thing, especially if it scales. Again, the reason why no one thinks about that now is because stable coins today only do buy Bitcoin, sell Bitcoin, or whatever other coin you want. If in the future, hundreds of millions of people have stable coins in their bank account or use it to make payments, etc., that's a whole different ballgame. And the last one is related to that, is there are no consumer protection rules. Everyone talks about how much cheaper stable coins are for consumers, but consumer payments come with a bunch of stuff. And you use a credit card, not only you get rewards, you also have the 800 number on the back that you can call. You use an ACH, you use a wire, you know exactly what can happen and what your rights are as a consumer or as a business. If you use a stable coins are by nature irreversible. That's a feature, not a bug, right? So what does that mean in terms of consumer use cases, merchant use cases, and so on and so forth? I think that's all stuff that's still to be defined, to be done, and to be thought through.
Staying with the use cases, in that case, what would be relevant to banks versus the merchants?
I let the bankers know.
Well, on this, as we said, it's pretty nascent, so there aren't really a lot of obvious, well-developed use cases. So we're kind of hypothesizing here, to be clear. But I think that So I'll share, my awareness of where folks are ideating and where there is some development in the marketplace. One is clearly, every bank has customers who are now, buying and selling crypto. And there's a way to kind of get in the middle of that transaction, at least participate as a bank. These are monies that are flowing out of the bank to Coinbase and others. And you certainly could contemplate being part of that transaction, helping them to buy a stable coin, which is then transacting with an unstable crypto. Another one is clearly payments loom large here, and sort of the threat case for this, and I'm sure we'll unpack this more, is fractional banking disintermediation that Takas just mentioned. The positive case is a really efficient payment rail that can process payments between unknown counterparties with real-time nature and instant settlement. So international payments loom large, and there's already developments underway by some players to provide stablecoin solutions for international payments. I think consumer payments obviously are another big area. I think Venmo, Zelle. You can imagine that all of those folks are beginning to think about how they could potentially turn that into a more tokenized blockchain related transaction. One thing that is also true, particularly in scaled banks, is there's a fair amount of intra-bank movement of money, and whereas that moves pretty efficiently today. So again, kind of back to the point of solution search for problem. One could though envision creating innovative digital first use cases for settlement within the bank. For flows, particularly those that are currently delayed beyond real time. So I'll just give you a sense within Huntington, we've done this analysis. There's about $30 billion a month that transfers within the ledger, but about a third of that actually is more than 3 days of arrears cleared. And so that's a top pocket. We said, well, let's go innovate an interesting stablecoin use case there. And then probably there's the last bastion that I'm thinking about is, as Takas just mentioned, tokenized deposits. So leverage the benefit of blockchain and all of that capability, but you don't need to use the coin. That's an unnecessary element of it, and you can transfer money between accounts, both intra-bank and interbank, potentially in a tokenized deposit form. That obviously would require some standardization, some kind of a consortium at an industry level to really know how to do that well. Someone like a FISO could play a role there, amongst others. And then there's the last place where there's a fair amount of work happening in the industry now is a settlement via coin between big traders and primary brokers, and then potentially even tokenization of the end asset that is being purchased. And so from a capital markets perspective, you can imagine, again, pretty fast settlement, particularly when real-time settlement is really critical for high volume trading. And then eventually that could, if you imagine a scenario where parties are settling via coin, well, then making the asset tokenized is a very natural extension of that. And so that could be one of the drivers of how assets get tokenized, is because all the settlement flows are effectively tokenized.
Yeah, I agree with all of that. I would say there is a lot of hype in this space, obviously. A lot of people that make grand statements about how stable coins can reduce cost of payment acceptance by like 98%, cost of cross-border payments by 95%. I think a lot of those statements are not actually anchored in reality. However, it is true that especially for consumers, there are things that are unnecessarily expensive. For example, money movement cross-border, especially to more difficult currencies, maybe not dollar to euro, but you want to send money to, let's say, Pakistan, or you want to send money to Vietnam, right? A lot of these places, the time it takes for the money to go from origin to destination is in days, even in the absence of any OFAC issues or KYC or AML. And some of it has to do with the complexity of the correspondent banking chain. So there is something to be said about this idea of kind of wallet-to-wallet instant transfer. So you eliminate the intermediate hops and you go from origin to destination. For younger consumers who are much more used to interacting with wallets, you can see a world in which like more global wallets emerge, like PayPal is kind of one example of that, more global wallets emerge that allow you to move money again real time to real time. You can see people in high inflation countries wanting to get paid in US dollars, which since they don't have access to in their countries, a wallet of kind of a digital dollar of any kind, whether it is Circle or Tether or anything, would be a really great alternative for them. On the institutional side, I completely agree with Zach that 24/7 money movement is an opportunity, depending on the efficiency of a financial institution or a corporate. It can be a bigger or smaller. I just don't want to underestimate the complexity of making that transition. On one hand, you now have 24/7 opportunities. On the other, you have 24/7 risks. And not every bank has the right kind of real-time DDA to manage that. Not every corporate has a real-time treasury to manage that. And therefore, sure, 24/7, but do you really know what to do with it? And then the other one, which is again futuristic, but it's worth talking about because the only thing that has more hype than stablecoins is AI. And there is something to be said about the future in which agentic commerce or AI agents interact with each other. And they need a smart currency that's instant and that can be based on rules that can move at the same speed with which those agents make decisions. And this is not cash, it's not checks, it's not even DDAs, because you need to embed the rules in the decision making of the agent. So futuristic, but to me there is some intersection between AI and stable coins that could, or deposit tokens that could potentially be interesting. A simple example of that, not much AI, but is supply chain finance. It's relatively straightforward to use a blockchain to set up a set of payment schemes that automatically happen, let's say for a boat that starts from place X and goes to place Y, and the escrow gets released automatically through GPS coordinates that track where the boat is. Contracts become much simpler in that way, and the number of lawyers required becomes much smaller as well.
Thank you. You touched a lot of scenarios, and we mentioned some of the risks, but what other risks could be associated? Can you cover them all, or anything that you would think of?
To me, just to tack on what we said before, the biggest risk is that disintermediation of deposits, which I would urge us to think is the most likely case, and to plan for that. Here's the scenario. What's going to be the duration of a stable coin? How long will someone hold a stable coin for? Will it be instantaneous, or will it be longer than that? And will it have a duration? Currently, there is something like 200, I think almost going on $300 billion of stable coins out. It's doubled each year for the last 2 years. That has an average duration certainly more than instantaneous. And that is where would those funds otherwise be? They would likely be in the form of deposits in some place. And so there's assumptions at this point that if you think about the U.S. banking industry, it's about 17 trillion in deposits, something like 1 to 2 to up to 4 or 5 trillion dollars could be ultimately held in the form of stablecoins. It kind of all goes back to the point that we were saying before, which is, are there backdoors around the payment of interest that wouldn't come to pass unless there was a way to really earn interest on those funds? But you can imagine either non-interest bearing deposits being cannibalized, or even the highest interest bearing deposits like money market getting cannibalized. And so my working assumption is that will happen. And therefore, maybe that's a contrarian view, but I think if you take that point of view, you say, well, what's going to be critical is to find the new services and the new revenue streams that are going to come from this, that will be unlocked by this, so that you could offset those lost economics. So to me, the risks are that you haven't been on the right side of how the industry will evolve. And if you just fast forward 10 years from now, I think a lot of things will change as a result of this technology. and the profit pools will have shifted. And if you haven't positioned your bank in the right place to earn rent, then that'll be a problem. I think the other big one to me is two things I would say. One is it will require new investments. So if folks are not actively thinking about how much capital and operating expenses will get allocated to this within their kind of investment budgeting process, then that will be a major gap. It will be costly. And secondly, it'll change unit economics a fair amount. So think about all of the different things that we've just been hypothesizing here as potential use cases. All of those actually are typically pretty high revenue yield use cases that are going to get displaced with a pretty low revenue yield use case. And so I think understanding those unit economics so that you can attempt to influence or at least have a preference for which ones develop the fastest is going to be important as well.
If I can just add a couple. So first of all, I agree with everything Zach said. I would add, the one thing that's not clear to me is what exactly are we trying to achieve with stable coins, right? If you look at other countries, they start with a problem statement, then they build technology to solve that problem statement. In China, for example, the issue was non-banks having a lot of deposits. Therefore, the country needed an interoperable payment system. Therefore, they launched a digital RMB. It didn't pay interest, and therefore the deposits were very close to zero. But as a payment method and as a resiliency method, it really worked. In India, it was about bringing people into the banking system, and they created digital identity, free payments for everyone, and they solved that problem. No need for a rupee CBDC. Here, it's not clear what exactly the problem is. Some people talk about reducing long-term interest rates. Other people talk about the predominance of the dollar. Other people talk about financial inclusion. So there is a whole host of different arguments that people make, and that is a little bit part of the problem. But I would say the risks would be any kind of payment of interest that's well above zero. I agree with Zach. That would be a really, really big risk. Because again, it's not the deposits go down, lending comes down, and so on. That leads to the second related risk, which is if stable coins become attractive, everyone will launch a stable coin. Not just the banks and the fintechs, but also large merchants and crypto companies and everyone else. And then you will have all of these coins in an environment in which volatility will go up because of the 24/7 nature of those payments. And by the way, most of those stablecoin companies have no business model. Their business model is the NII arbitrage. So if there is, a recession and interest rates come down close to zero, half of them will have no business model. So then what happens to the consumers who have trusted their money to those stablecoin companies without consumer protection rules? Based on history, it will come back, to the banks, which are, the only ones that people trust. So for me, issue number one, therefore, is deposit outflows. Issue number two is brand new systemic risk that we're generating. And then issue number three is that increase money velocity. And what does that mean about both banks and companies, risk management and technology capabilities, tools, risk management methods, etc. Otherwise, it's all great. It could, right? You can totally see the spiral, right? You can totally see how it would happen, especially since stablecoin companies, the existing ones, have no other revenue model except take money at zero and let borrow at lend up for. It's a great model.
Yeah. Thank you. How do you think about the consumer protection for the consumer protection for them?
Again, it depends on the use case, right? So right now, the use case is buy crypto. I think it's relatively straightforward. I mean, you hear every now and then people getting hacked, etc. I think the moment people start using stable coins with their banks because they trust the banks, or the moment they start using it for consumer payments because they're used to doing consumer payments in a certain way, they will expect a heightened level of support if something goes wrong. We've seen that with Zelle, which started with basically nothing, and then people scrambled, even though by the way, the fraud rate is really low. So I think banks in particular, if they want to touch stablecoins, if they want to use them as a payment method outside of their own ecosystem, they need to think very carefully about what the consumer protection rules. And again, to the point of interoperability, the consumer will not say this is a Huntington Bank coin or this is a Fifth Third coin. They will see a coin, they will assume it's the same. And by the way, if they don't believe it's the same, they will not trust any one of them. So it's kind of very important to set those rules before you start seeing too much adoption.
So, let's keep on meeting. So what should banks do when they think this conference, when they think about stablecoins?
So first call Faisal. No, I would say the first is just educate yourselves around what are the opportunities, what are the risks for the kind of business that you run and the kind of customers that you have, consumers, wealth management, retail, wholesale, because it's not one size fits all. And like the large banks will probably either on their own or together will go and do something themselves. I think for the smaller banks, you need to be more thoughtful because it will come, as Zach said, with investments. It will come with risks. You probably shouldn't ignore it. And therefore, you should get educated, think about the opportunities, and then figure out which components of that do you want to play and at what speed you want to go in now and be one of the leaders. Do you want to wait and see what like Huntington does and then go from there? Just waiting too long is kind of a little bit of a risky approach because other banks may move faster and fintechs definitely will.
Yeah, I totally agree with that. I mean, this is not a bury one's head in the sand moment for sure. This is a keep head up on a swivel moment. To me, there are four. So in addition to the general, just stay pretty plugged in and learn. And I would call it four specific things. Firstly, from a technology infrastructure perspective, it's useful to challenge your technology organizations and folks that are responsible for product development. What would it take for us to participate in blockchain related activities? And I think when you really start to think about it in a practical way, there are 4 or 5 or 6 sort of key elements to that capability that you can start to get the teams practically up to speed with. They need to learn how to read and write to the blockchain. They need to have custody and wallet. They need to have connections to exchanges. They need to have transaction monitoring and oversight. There's a variety of sort of fairly practical steps that you could begin to ready oneself for. And then, it then becomes fairly obvious, well, from whom would I procure these things from? Who are the best in class? How do I get up to speed, on those technologies? So that's a pretty obvious, no regret move, in my opinion. The second one, and I mentioned it earlier, but it's really important, is to watch the use cases develop so that you can be ready to be a fast follower. There will be some who really try to be at the bleeding edge of innovation, but I think for the most part, most of the 4,500 banks and financial institutions in the United States will probably be fast followers of this. And the key will be not getting left behind. But the good thing about the banking industry, just for what it's worth, I came to banking 6 years ago from the payments industry, and I've had the opportunity to kind of just think about banking in this industry quite a bit as a result of that. And one of the things that's good about it is it's been around for thousands and thousands of years. So I always tell my team, it's probably got to be around for thousands and thousands of years, but you're not guaranteed to be successful in it. And so I think watching how it's going to evolve, there will be winners and losers, and really, I think to some degree, as people unlock these use cases, every bank it will need to quickly figure out how they will solve that same gap. My hypothesis is that will be solvable, and there'll be industry players that make it available to banks, but we'll have to kind of quickly get it. The third thing I would say is learn the unit economics. So once you have a sense of, okay, if these are the 5 or 6 hypothetical use cases, you can then ask yourself the question, well, what do I make today on those kind of transactions? And I would posit that in many cases, folks probably don't have a great handle on that today. And I think once you see it, then you would say, ooh, actually, I know this use case would be really damaging for me if that took place versus this one, actually, I'm fairly agnostic to, but I actually want to push that one. And there's an opportunity to start to optimize. And the last thing is sort of maybe it's obvious when we look for the opportunities. I do think that if you take a step back and say, let's start with the customer for a second. What are the jobs to be done for these customers, consumers, business customers, large commercials? You could start to think about interesting opportunities to deploy blockchain in that way. And I think that's where it will be fun and interesting to participate.
This was really good. If I can just add one point, which is the whole blockchain infrastructure has been built by a variety of fintechs using modern but very open infrastructure, and it's part a little bit of the ethos of the blockchain community, which means everything is open, everything is available, and therefore being able to play in that space, as long as you understand what you're doing, the barriers to that are actually not very high. You want to create, you want to mint and burn, there are companies that do that. You want to do AML KYC, there are companies that do that. You want to have your own crypto wallets, there are companies that do that. So there is a whole ecosystem of fintechs that do a lot of those things on their own and that are very easy to connect to. So I guess the only thing that I would add to Zach, and that's kind of what we do at Fiserv as well, is just we plug some of those things and we try them out to see how good they are in proofs of concept. And see, when they say they can do 4,000 TPS, is that real? If they say they can do it in fractions of a cent, is that real? Can they really create 100 million wallets in half a day? So I think trying some of those things out will help you get a little bit more familiar at low cost and zero risk, because it's going to be just proofs of concept.
I would add two things. I mean, first, it is important for BAFT, so download our paper and follow BAFT. So when we issue more things, you're aware of what's happening in the industry. I want to move, since we're getting out of time, I want to move to the audience questions. If anyone has any questions for the panelists, you have Mark? Yes, George.
Yeah. Some of the premier tier one banks here in the States have issued stablecoins, or they plan on issuing them. There's a consortium of European banks as well that have gotten together to issue a euro stablecoin. So what do we tell the regional banks? Is there a factor of FOMO if they're not going to issue stablecoins on their own, or what do they do? What is that advice? And I'm opening that question to any one of you that, or several would like to answer that. I don't work in a bank. I work at a fintech. I don't issue stablecoins. I don't plan on issuing stablecoins, but I'm just curious to know from a regional bank perspective, what do you do?
Yeah, I've thought about it a lot. It's interesting in outside of my office at Huntington Bank Center in Columbus that there are printed currency with the Huntington Bank name on it that go back to the 1800s when every bank had sort of printed their own currency. And to some degree, you could imagine the analogous situation now where every bank is printing their own digital currency. And I think there's a pretty strong reason to believe it won't go that way, just like it didn't work too super well when every bank was printing their own currency, because it's just not scalable. And my presumption is there will be 5 to 10, maybe even fewer, big issuers of coin. And they'll have the brand recognition, they'll have the interoperability between other sources. They'll be plugged into, the exchanges with scale. And so it's not probably practical for individual institutions who don't have significant scale to issue. And so I think, and yet, if you go back to what I was saying before, to the extent that this does actually cannibalize sources of liquidity and therefore fractional banking and the economics that get multiplied from that, the only saving grace is you've at least earned the HQLA yield. And if you're not the issuer, then you're not getting that either. And so it's a kind of a conundrum. I don't know that we know how it's going to play out at this point. With that being said, there are reasons to be somewhat optimistic. To some degree, one could imagine an economic sharing within the value chain, which is something to the degree of, if it's my customer that bought the coin, I should have an economic interest in the yield on that HQLA. And so that's a pretty logical way that would incent me as a financial institution to preference a coin, to get my customers to use it, to want to invest in the infrastructure to move it around. And so my sense is that something like that will probably come to pass. And there are plenty of money movement use cases that don't actually need a coin. And I think that that's also going to be probably an area of a lot of pretty fruitful evolution, because there's much less economic interest for banks, frankly, to disintermediate themselves and take deposits and turn them into coin. I'd much rather just trade a deposit with you as if it was cash. And so I think, there's reasons not to be too concerned. And yet I think the winners will be those that are very forward and ready to capture those opportunities, who already know what the infrastructure is going to be like, already have some practical experience working with this, and who can kind of envision the way that they can plug into a new value chain.
Does the ABA, American Bank Association, have any opinion about, do you know about stable coins? And because I think originally they kind of fought the whole idea for.
I wouldn't speak on behalf of the ABA, so I don't know the answer to that.
Question really quick back here.
So you've mentioned it more than once, the reduced liquidity for banks. That's got to be scary as anything you have said. So I wonder if the offset, what you said is creating other value, replacing the lost revenue, all of that. I'm not asking you to share your playbook or what you're thinking, but is it like safekeeping? And are you going to get people? Well, customers pay for you just to report to them what they have going on with their deposits in stablecoin. It just doesn't seem like there's enough. And maybe that's because I'm an old guy and I'm not very creative, but I can't see the value in what a bank could come up with as a replacement for the lost liquidity and the revenue stream of the margin or the interest.
If I can maybe start. So first of all, at the systemic bank level, there is no alternative, which is why I find it very, very hard to believe that interest will be allowed on stablecoins. And if it is, it will very quickly become clear that this is untenable and people will walk back. Actually, the Genius Act says no interest. It just leaves it a little bit vague on what kind of rewards, and we've all seen all of these DeFi protocols that pay interest, etc. So if interest is close to zero, then you're not going to have a lot of deposit outflows, and therefore that's not an issue. Second, banks, if there is any kind of interest or any kind of outflow, I would expect banks to be much more proactive around deposit tokens that give you the same value without losing the liquidity. Third, there are ways, and that's why we bought this company called Stone Castle, to recycle some of those deposits back to the bank. So as Zach said, at least keep some of the liquidity value if it's not 100%. But there is no way the system can make up for the loss of liquidity, which is like the whole reason that banks exist. I think to your question before, I would expect the big banks, well, I don't know that for a fact, to follow a similar approach to Zen, which is to create one system that's interoperable among them. And then I would expect, and that's also what we are trying to do, is to make sure that everyone else can have a coin, they can call it whatever they want, but on the background, all of this works seamlessly with each other. They have the same KYC, AML, consumer protection rules, and everything else, so that it operates as one. And we go back to the second half of the 19th century, not the first half. So, you have your printing press, but at least there is a central bank somewhere checking something.
Yeah, well, I agree with that. I do think that the hopeful future is where much of the value of the blockchain-related programmability can be achieved without necessarily moving the money into a coin, buying HQLA. It's sort of an unnecessary step to some degree. And if you can get an interoperability for tokenized deposit movement, then it's just basically payment flows in a different manner. I think the reason to be a little circumspect, however, is if that was true and there wasn't some economic sharing ultimately of the yield on the HQLA and also back to customers, there'd be a huge profit pool available for issuers. And it would just be this massive profit coming. And you think of Tether right now, right? A company with like 200 people and $13 billion of revenue. that's not a sustainable model. Something will happen there, and ultimately that money will flow back. So I think there are reasons to be optimistic, but also a little circumspect here. The good news in banking is that typically the average bank earns the cost of capital. And ultimately things sort of reset, whereby the yield on loans and the yield on deposits is calibrated such that the spread will achieve the cost of capital on average. And so the question will just be, who are the smart banks who can develop innovative new fee-based services to kind of offset that? At an economy-wide though level, it is a concern, and I think, we'll have to see how it plays out.
We have our last question here.
Yeah, I have a question, like, when you launch your own tokenized deposit, are you using the current core banking system? Or are you using like a distributed ledger technology? Because DRT is basically the foundation for the whole blockchain stuff.
So I'm not sure if I understand exactly the question, but the way we would think about both stable coins and deposit tokens, it will be sitting, at least in our case, on a Solana Ethereum blockchain. And then on top of that, there is a ledger that keeps track of all of the activity that then goes back to the custodian that you're going to have. That then in turn is exposed to the bank clients through their existing digital front end as an alternative deposit option. And then it's linked to the existing bank DDA to keep track of any liquidity gain or loss. So in a sense, that will be like a new payment rail or a new deposit rail that will sit on top of the bank's existing DDA. And we are doing it like that so the banks don't have to go through the brain surgery of changing cores. Existing core, this sits on top of the core, keep tracks of blockchain activity, connects to Ethereum, connects to the consumer side, and then settles at whatever is the right frequency.
Yeah, so basically your tokenized deposit is launched on like Solana or Ethereum, all those blockchains. So basically there will be a token in this case.
For tokenized deposit, yes.
Okay, thank you.
I'm sorry, I don't think I answered the question.
I think we're out of time. Thank you very much for our panelists.